Thursday, September 8th, p.m. All kinds of things in the news. I think we've lost a great person from a prior generation. The Queen passed away this morning, and that's sad. She accomplished a lot in her lifetime, transcended all kinds of problems, wars. Quite a lady. I come today to hopefully update you on what is going on, and unfortunately it's been like watching paint dry. The stock market hit a low in June and had a long belated rally of 4,000 points upward, only to meet the top of a downsloping chart pattern, and it turned around and lost 3,000 points in the last month. So we are back really at a level that we hit somewhere last May. So June, July, August, 4 months of backing and filling, a lot of volatility, but in stocks, you know, we're still relatively near the low and at the 31,000 level, the high being 37,000. But it's not all clear yet. What has happened to us during this entire time and prior is the interest rate battle that the Federal Reserve is waging to try to lick inflation. And we have interest rates near the highs that they've hit on this whole cycle. And so interest rates seem purged to leap upward again, because the Fed chairman is talking about a 75 basis points or 0.75% change. And a lot of interest rate observers on Wall Street are saying we're not going to hit a top until the actual interest rates are higher than inflation on a short-term basis. So inflation is beginning to come down, but it's got a long way to go to 2%, which is the target. And with interest rates at 3.5%, it's probably got a long way to go until it meets the inflation level. And that's the fly in the ointment. So as we look at the market, it is reflective right now of what's happening with the Fed, with interest rates. But that begets another question. If he's going to keep raising rates, will we get in a steeper recession? We believe we're in recession now, but it appears to be a shallow one. And the problem is, if we get a deeper recession, then you get an earnings picture that is bleak. You start to project earnings for the Standard & Poor's, for the Dow Jones, and it looks down. And the worse the reception, the further down it looks. So this is all of the stuff in the background that's just preventing the market from looking at the positive side and taking off and running. See, we have knocked, say, 15% out of the stock market on the downside, and that's largely been a price-earnings ratio change related to interest rates. If interest rates go up, the discounting mechanism for earnings goes down, and we have come together this year early at an all-time high with price-earnings ratios. So we've had that correction, and the stocks that really take it are the stocks that sell at a high price-earnings ratio, 50 to 100 times earnings. Well, those have been beat back down to maybe 30 times earnings, towards the norm. But the actual earnings decline, which may be with us with a recession, with this interest rate battle, the actual earnings decline is a big question mark. And that's holding a lid on the stock market. So as we sit here at 31,000, it's more backing and filling. And I really believe that the big kahuna out there is the election. And until the election is over and we get a decision as to what kind of a country Americans want for themselves. Is it a country with big government, a lot of regulations, increasing taxes, redistribution of wealth, and all of these things? Or is it going to be a country where they want freedoms back with more latitude, more laissez-faire, so the American profit spirits can begin running, which the stock market would love. We don't know. We don't know. The country's split, investors are split, and so it's like watching paint dry. That's exactly what we've been going through. But we're still reluctant to put a lot of money to work beyond your risk tolerance because the risk is high. And I haven't even started talking about how dangerous China is, what they have planned in that part of the Pacific. They're starting to rear their ugly heads. I have not talked about the global economy, some of which is in a disaster. Russia stopped the gas from flowing to Europe. That's going to be terribly disruptive. So things are not good anywhere. There's a lot to worry about, and our immediate concern is what happens here with our head of the Federal Reserve Board and how tight he makes money and whether he pushes us into a recession. So we'll deal with that one, and then we have to deal with the election. To try to figure out the Russian war with Ukraine, I mean, that's off the scope. It's not good, and it does create some trade problems, but listen, the barrel's already full of worries, so we don't have to concoct any more. Suffice it to say, we still are conservatively postured and still want to remain defensive because we don't have a definitive enough reason to get bullish. And I think that the first one of those reasons is going to come up after the election. So we sit tight, and thanks for hanging in there for some latest information, but there's very little. It's the same old struggle, and I think we got another month or two of it. Have a good day, and if something does pop, we'll be right with you. Take care.